Hello, everyone, and welcome to the weekly roundup. Today, we will cover tariffs, interest rates, and market sentiments. Hello, Ben.
Hey, Eva.
How's it going?
It's going good. I'm feeling, I don't know if you can see this over here, the Peace Tower. It's a good day to be patriotic.
Yay.
That's
And the
it.
weather is good.
Yes, as well.
We're
Yes,
getting there.
we are. We are.
It's been an interesting week. We're starting off with the big news tariffs. Trump imposed about 25% on Canada and Mexico and an
hmm
additional 10% on China.
hmm
What is the implication on this on global inflation and growth?
Yeah, so it's a great question. I think the question of the day. And as we have conversations with lots of clients, investors, and as many analysts and economists that we can talk to as well to kind of get a thinking around what and how this is going to have an impact. And we start our view with what's going on in the economy, and over the years spend most of the time talking about economic environment. And so I think it's still important and relevant. It's the geopolitical risk that's really thrown a wrench into everything else. And the challenge is looking back at history and saying, when's the last time we had this kind of, I'd say, stringent tariff risks and conditions? And, it's probably 100 years ago, literally. Like the 20s was probably the last time we've seen this strict tariffs trying to be imposed. And so it's going to be a bit of a cat and mouse right now and to pay attention to what's happening. And so, I think the Trump presidency and the US government is extremely focused on a really narrow path, which is tariffs. And so there seems to be that super focus on that. And, I'd say the optimistic piece of me says it pushes Canada together and the provinces start to work together and projects get moved along faster. But to the start of your question was, what does this do to GDP and inflation? I think it should slow GDP faster than we're currently predicting. And so it depends on how long it stays on and how many concessions. And now they're talking about auto concessions. And I saw something this morning about ag concessions and taking the tariffs off on Mexico. And so there's a lot of moving parts, but really it would slow the GDP a little bit faster. And from an inflationary perspective, that's a great question. Assuming the economy slows, it should be fairly neutral. But if the economy picks up and reaccelerates, it's probably slightly positive to the inflation side of things. But inflation is a 12-month number. So every time 12 months ago rolls over, a new one kicks in. And so I'd say it's fairly neutral right now. And then the next point, obviously, is let's see what happens. But really, it's a day to day, hour to hour. Before I get onto the call, I had to look at what's going on in the world, and nothing's really changed except for there's more tariff talk. And I think you asked me the last point about China, and what they're thinking about the tariffs being put on them. They've come out this week quite aggressive in their talk, and they said they're really ready to fight if necessary.
Interesting.
Yeah.
Let's jump into interest rates. Most central banks meet this month. I think ECB is starting off. With the inflation dip they saw, what do we expect from the ECB this coming week?
So the ECB today, I think it was their announcement was today that they cut
Oh,
rates. Yeah.
mm,
And next week we got to Bank of Canada. So the ECB, I think, continues to try to stimulate the economy. We've seen actually European stocks do quite well in the past 6, 8, 12 weeks here. And so we've seen Germany settle a bit on their politics as well. So they that has been settled. Once France has a new leader as well, that's going to help. But I think some of the things that have happened with what Trump's been doing is he's really been forcing Europe to closer together. And so where you may have had a divided countries for the past many years, you've seen them get a lot closer together. And I think as a result of that, the ECB is also going to be supportive for what they need to do to get their economies going. And so I'd say that continues to be the case. And then the Bank of Canada. Did you ask me about the Bank of Canada for next week? But
Man, it's next week. We can have a look ahead.
yeah, for sure. So coming into the start of the week, we had a 41% chance of a cut next week, but that was prior to the rate announcement or the tariff announcement. So I'd say we're probably closer to 80% likelihood of a cut next week. We got to wait for the updates. But certainly after the tariff announcement, I'd say that you started to see rates move down and lean towards the fact that there'll be more cuts to come.
How has market sentiments been this week following the announcement?
Yeah, so I think the sentiment continues to be concerned. So if you look at the fear and greed index, you can look at many different ones. But if you look at the mostly publicized one, which is CNN's, I think we're somewhere around 17, 18 on a scale of 0 to 100, with 100 being super aggressive. So I'd say the market's being quite concerned. Sentiment's been quite negative. And as I mentioned in one of the dailies this week, is it's a great counter indicator. And so stocks down and people are scared. Okay, that's probably pretty good. That's probably good from a perspective of when you want to look to buy and add things. And, some of the Canadian energy names that we're seeing hit new 52-week lows here, which seems uh, mostly a reaction to fear as opposed to a reaction to the fundamentals of the companies. And so, yeah, sentiment's bad, which is a counter indicator for me when I'm thinking about what's going on in the world.
Yeah, let's go into the charts.
All right. So we are Thursday, March 6th, recording this. So anything that happens after this, we certainly won't comment on. But this is one that I've been talking about, and I think most people probably are semi-familiar with this. And I think this is the reason I think it's relevant is because it's the one thing that President Trump is not paying attention to. And so where GDP breakdown from a simplistic perspective is 89% of the GDP is internal and 11% is exports, we'll say. Okay. But the one part that I think that he's missing is that S&P 500 foreign sales as a percentage of sales is more of a 60-40 domestic to foreign. And so where he historically has been a pro-business president, I think the part of the tariff attacks and such is missing the point around, what the impacts are going to be to his companies. And where this is relevant to us as investors is certainly if S&P companies' earnings come under pressure, that means that the stocks are likely to come under pressure. And so to answer your question a little bit around how the markets are reacting to all of this, and so every time more tariffs are threatened, you see the market start to sell off in the face of that. And so, I think it's a lot of volatility, as we talked about earlier this year, will continue to be the case. And this will be an interesting piece and partly, I think, important to think about how and if he should walk back some of his comments, and maybe that's why he has. But it's a volatility of what's being said and done. And I think the missing piece is just around the amount of American companies that earn their revenue ex US will have a material impact for what's going to happen from this point. But just from an equity leadership perspective, I know when we spoke in December and into the start of this year, just around where potential turns and or opportunities could be. And I thought this was an interesting one. This would be the S&P 500, which is the blue line. And then you would look at EFI, which is the gray line. So this is the blue line. Obviously, you got outperformance of the S&P for quite some time now, a couple of years. And if you compare it longer term, you can stretch that out to make it 10 years. And US has outperformed, Canada Emerging markets is the blue line here. Canada is the red one, and then EFE, which is Europe, Asia, and the Far East. So what we've seen since the start of the year, which was one of the things that I commented on, is that valuations in emerging or in the international markets are extremely more attractive than U.S. companies. And so we've seen outperformance from EFE, which is Europe, Asia, and the Far East. I do think this likely continues, but this is a great chart to continue to watch and pay attention to. What I thought was worthwhile as well, we have a research team, our chief investment office, that always puts out a piece just around what they're thinking about, and sometimes this is trying to understand what exactly this means. And so, from a sector perspective, this is Canada, so energy, materials, industrials, discretionary consumer staples, so on. And then there's what is the weight within those sectors in the market. And so right now, when we're looking at energy is about 16.5% of the TSX. So our view from National Bank Financial is market weight, materials market weight. And then when I think you look at where and what you think about how we're going to do here is, do you want to be overweight or underweight? And this really just helps your thinking around the view around what's going to happen in the economy. Do you think industrials will do well, or do you think consumer discretionary will do well? So underweights would signal that we think the economy is slowing, because consumer discretionary and industrials don't do well when the economy is slowing. And then when you look at what our team thinks, which is consumer staples, those would be the companies that provide the things that everyone needs every day. You would take an overweight position. Similar, if we look down to the telecommunication services, so that'd be your Bells, your Rogers, and TELUS and such. So they had difficult years last year, and paying now high dividend yields. So the telecoms are moved to overweights. And so this would match our economist team view on what they think is happening right now, which is a slowing Canadian economy. So you want to have some exposure to some areas that do well in that backdrop. And so I thought this was a cool way just to think about some of the behind the scenes, how you get from economics to market positioning from a allocation perspective. And so the last one, just on what this means here, any of the opinions here are not necessarily expressed by those of National Bank Financial. Some of these opinions are mine. You should always consult your financial advisor and or me if you have any questions around what and how the things we discussed here will have an impact on the portfolios.
Thank you, Ben.
No problem.
I know we spoke about Bank of Canada meeting next week, but is there any other thing on the agenda for next week?
So I think going to be more tariff talk.
I bet.
But no. So one of the things that did change this week as well was the U.S. Fed. From a rate cuts perspective, we came into the start of this year with expectations of 75 basis points. That got back to close to zero cuts, and some people talked about potentially raising rates. And then as we got back into the tariff talk this week, you've seen the forward curve move back to the fact that there's probably 75 basis points of cuts to come this year in the US. And so that'll be worth watching. That gets reported on the Fed Watch tool, which I think I've put up before, but that's a great place where you can look on a continuous basis. It gives you a view on the forward curve on rates. So certainly be watching that, because that'll have an impact on a lot of things. Bank of Canada is a big piece, and that's flip-flopped so many times this year as well, where we went from 100% chance of a cut in March to 0 to back up to 40, and I guess we're going to see where we settle out, but I think that'll have a big impact. Last time when the tariff threats came in, you saw massive revisions to GDP and inflation expectations in Canada. So I think there'll be lots more to cover and read. And if these tariffs continue to stay in place in Canada, short-term bad impact GDP-wise. What happens likely in that backdrop is rates get cut faster, and stimulus gets put in place quicker. So lots to watch and pay attention to, and so that's what we'll be watching up ahead.
Great. Now, on to exciting news. Our daily financial heartbeat is back and better. I would put the link to the new website in the caption of this video when we upload it on YouTube. Remember, our YouTube handle is Hart Investment Group. Please follow us, subscribe, and like the videos. For our clients, reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening, everyone. Have a good weekend after you get through Friday. Bye.